Good morning, good afternoon, everyone around the world. How's everyone is doing today? My name is Elliot Morarat, and we're gonna start in a few minutes the seminar uh, that we wanna be performing. When we start these seminars, we always allow a few minutes so everyone joins. It's a lot of traders here in the seminar. I would like to know if everyone is able to see the screen and everyone and the audio is working in you guys, in your end. As a rule, if anyone can let me know, Myra, everyone there, if the audio and the video is working, I would appreciate it. Uh, eh, Anyone, please? Audio down, everyone. Is the audio working? Everyone there, please.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, everyone around the world. My name is Eric Moreira. I'm a senior analyst for Elliott Wave Analysis. And we're going to perform today a seminar about the commodities. I would like you guys to let me know first and all if the audio and the video is working in your end. We're going to start the seminar in a few minutes to allow everyone that is registered to join us in the session. The seminar is going to take about an hour or so. And the rules of the seminars are we're going to do our presentations and we will ask you guys please to reserve the questions to the end so we can present the seminar with a nice flow. Otherwise, there's going to be a lot of interruption during the seminar. The main idea of the seminar is that all you guys came out with an idea of what the commodities should be doing for the next year or so. Yeah, the seminar is gonna be loaded in YouTube and the homepage of EWS. Everything. Yeah. Allow me a few seconds. So, like I say, to be able to allow everyone to be able to join, uh, everyone to be able to join the seminar. So it will be very interesting. We're going to explain the reason and put a lot of examples of our view and our thinking about the commodities. Some of the views might be ending contrarian to the popular belief, which is good at the end because being in the popular belief about something in trading usually is not good at all. All right, so it's a 12:40. We're gonna start at 12:42 in 2 minutes. And like I say, it will be very interesting in our opinion. I mean, Benjamin, I would at the end I will be able to check some extra instruments if you want it, but that's not part of the seminar. I mean. But if all the commodities going higher, I guess that the one that you're referring to also will do the same. All right, guys. So one more minute and we start. There is a lot of followers or traders already there. I think that we fully booked. That's good, right? Right. Good afternoon, everyone. All right, guys. So here we go, guys. Let's start the seminars. Welcome all to another free Elliott Wave Forecast seminar. This time around, we're going to talk about commodities and what is next in 2023. As everybody knows, for the last 2 years, commodities, they have been in a decline, but that's an opportunity in our view. Most of the retail traders, they're always trading what is called the latest trend, and most of the time they don't anticipate what should be happening next. And and consequently, they ending caught in the wrong trend of the market. So today's seminar, we're gonna cover in today's seminars, we're gonna cover these following topics. We're gonna explain to you guys overall, knowing details, what the Elliott Wave cycles are, because I hope you guys understand this is key, all right? Understanding the Elliott Wave cycles, because eventually the market, last time I checked, it do not run in a straight line. There always is an advance and a pullback, no matter if it's to the upside or to the downside. We're gonna cover the Elliott Wave structure so you know what it is an enforce, what is a correction, the correlations. Then we're gonna cover the U.S. dollar in the grand super cycle. We're gonna cover the Elliott Wave structure, silver, gold, the gold to silver ratio, the correlation of gold, the grand super cycle, and a number of commodities, and explain our conclusion. At the end, the idea of the seminar is to look at the cycles correlation, Elliott Wave structure, and major commodities, ETF, gold, silver, and then came out with the conclusion. As I always say, an Elliott Wave forecast, and for those that doesn't know us, Elliott Wave forecast, it was created in 2005. So we are almost 2 years away for our 20th anniversary. We covered 78 instruments that goes from stocks to ETF and also goes to indices, commodities, everything, interest rate, everything. So we provide three main groups, and we provide also a 24-hour service. In other words, our analysts, they always are in your hands, right? You can always type a question, and there's gonna be somebody there to answer for you guys, right? So that's the main idea of the seminar. And we're going to start with the degrees. These are the degrees right here, all right? Most of the traders, unfortunately, they trade in this lowest degree, most of the traders. That's the reason, like I say, why 97% of the traders, they don't last 2 years. They end up losing. We see it daily in our chat or interaction with the client because they want to know every single swing of the market. And that's impossible, guys. This is 2023. This market is ruled by computers. And consequently with that, computers are the ones that they're able to trade in every single time frame, right? Computers are the ones that they're able to trade in every single time frame. In other words, computers they're always pumping and taking money out of the market. Human beings, the lowest the degree, the chances you are to be wrong. Why? It's simple math. In a century, there is 100 years, which is the grand super cycle. And in a year, there is 52 weeks, which is the super cycle degree. And the cycle degree is kind of the daily chart, in which there is 365. But I want you guys to go to see and understand how it goes for 100 years to 52 weeks to 365. The number is getting bigger. Then there is in a year, there is like around 400 4-hour prints. That's the primary cycle. Then there goes to the lower cycle start, the 1 hour, the 30 minutes, until you go to the lowest time frame, which is the one that most people end in trading, which is the 15, 30, and 1 hour charts. So in a year, for example, there is over or around 8,000 prints or possibilities in 1 hour. So this is simple critical thinking math. The lower the number, the higher the chances that you get it right, because there are less chances that you get it wrong. Yeah, the stops or the risk, it gets wider, it gets bigger. But if you use a rule that is the money management rule, in which you always risk the same amount of a risk, a 2% as an example of your capital, you can catch a trade that can last 2 or 3 years and make a lot of money without stress, but with the highest probability. So that's why knowing when it comes to trading, that's why that's why knowing the degrees is important. Also, it's important to understand that it's important to understand where the market is in the highest degree to forecast, as a forecaster, as an analyst, to forecast the lowest degree. In other words, if you don't know when gold is trading in the grand super cycle, if you don't know that when gold is trading in the grand super cycle, you are not able to forecast, let's say, the primary cycle. Everything goes as a machine. Everything is related to the other, right? And that's what knowing the cycle's degrees is important. Any question about this topic? I want to be asking to you guys for questions. So you guys, you guys, you guys understand what is as far as we're moving forward. So everyone here understand. If you got any question, you're free to ask. Anyone here understand? The sound is very good, to be honest with you, Giancarlo. the sound is pretty good. It might be your internet connection. So eventually, yeah, we will talk. I mean, we will do a presentation about most of the instruments. Thank you, Praveen. Right. So everyone understand here the degrees of the cycle, right? Everyone understand that, right? The degrees of the cycle. Very clear, right? But at the end, some Elliott Wave guys use kind of the different degrees, but at the end, it's the same idea overall, right? At the end, it's the same idea. And about the sound, guys, I mean, this is an internet. My internet is very powerful, and you guys might have a slow internet, and that's why the sound doesn't come so clear for some of you guys. But overall, the sound is pretty good. So the next topic that I want to present to you guys is in relationship to the Elliott wave structures. It is important that you guys understand how the market moves, right? We understand the degrees and now how the market moves. This is what is called an impulse. An impulse is 1, 2, 3, 4, 5, and in every way, every time that you see the number 5, that is a trend. Either 5 swings, 5 swings, or either 5 waves. So a 5 swing or 5 waves here, 1, 2, 3, 4, 5, is telling me that the instrument is bullish. And is bullish either in 3 back and another leg higher, or it can be also doing a net, which is a combination of 1, 2, 1, 2, and then higher. Then a most of the time it's bullish, Mike, unless it's a flat. But if it's a flat, it's because then the instrument has what we call 5 swings, right? And then it can show 5 swings up to here, trade lower in a flat, and then restore in the direction of the 5 swing. And that's the question that you were asking. This is a downside impulse right there, and it's how the market moves when it's trending. It's how the market moves when it's trending. There is always in the cycles and the degrees of the cycles that I explained it to you guys. Always, there is one degree that is trending in 5 ways, like the case of gold right now. Gold, it was correcting for 2 years, but the overall direction of gold is bullish. Just that if you look at the last 2 years, you need to understand that is within the correction. So that's the downside 5 ways, and the previous was the upside 5 ways. Like I said previously, there is sometimes something that is called extensions. And sometimes in another way, I'm gonna go fast here. So I'm giving you, I don't know the expertise of you guys as a waver or person that use the way. So I'm giving you the overall idea about how the market looks like in our views, right? In our eyes, so you guys can understand my language when I get into details about the commodity. So this is a first way extended. Always one of the 3 legs are extended. In this case, this is the first. This is the third, which is the most common. And this is the 5 that usually, when it comes to commodities, they are popular for doing extension in 1 on the OO index, on the third modern Forex of the indices. So commodities usually, in indices and Forex, usually the wave 3 is the most extended, but in commodities sometimes happens on the first and on the fifth. And then this is the swing counts, 1, 2, 3, 4, 5, 6, 7, 8, or 9. Usually that's when there is a sequence that it runs 5, 9, 13, which is what we have made it popular around traders, which is a sequence in which when there is an impulse, usually the impulse runs in sequence of 5, 9, or 13 overall. All right, when it's correcting, it runs in 3, 7, and 11, and it's an opportunity to buy the trend. Also, we have here what it calls the wave 3 extension, and I'm going to show what a net means, what it means overall. A net is the following: 1, 2, 1, 2, 1, 2, and then it comes the extension and the acceleration in the wave 3 of 3. This might be happening now when it comes to gold, silver, and copper, part of the commodities. This might be happening at this moment right now. And usually what happens is that most of the traders end up missing, because most of the traders, when they see the previous impulse right here, they see 1, 2, 3, 4, 5. Most of the traders end up selling and picking the top, and they're left with being in the wrong side. That's one of the reasons why in Elliott Wave Forecast, as a company in general, we don't pick tops and bottoms. In other words, we identify the right side, and then we go and buy in 3, 7, and 11. And when the market is in this case, right here, instead of telling members to sell because there is 5 waves, because if you guys look at it from here up to here, everyone, that looks identical to this, right? Everyone understand what I'm trying to say? They looks identical. Yes or no? They looks identical right there. It's 5 waves. They looks identical. The only difference is that the market is powerful, and instead of correct the whole cycle, the market extends. And that's what is called a net. So in Elliott Wave Forecast, we are different than most of the Elliott Wave servers that you guys see around, or we practice Elliott Wave differently, right? Besides that, we have added a series of rules, new rules to the Elliott Wave theory. The way that we practice it is different, because we understand all these traps that the market presents to us, and we have a system that is telling you what a net or when a net might be taking place, right? So that's what is called a net. It's important to understand. Right? That's what is called a net. That's what is called a net. Now, correction is key, yeah, right? It's key. Over my career as a trader and almost the 20 years in Elliott Wave Forecast, I have been able to deal with hundreds and hundreds of traders and thousands of traders. And I have learned from people mistakes, right? For example, you guys can analyze yourself individually there and understand what I'm going to say. Most of you guys say, I'm going to trade only gold. I'm a gold trader. I'm going to trade the S&P. I only trade the S&P. I only trade gold. And you believe that you're going to be successful only trading one instrument. That's a mistake. The market as a whole, it works as a what we call a one market only. Everything is related. The dollar is related to gold, of course. Gold is trading against the dollar. But GDs, which is the ETF of gold, is related to the S&P and is related to the indices. ExxonMobil is related to oil, and oil is related to the dollar, but ExxonMobil is related to the indices. So thinking or trying to trade without using market correlation is a big mistake that is performed or is done every single day across the market by traders, that they don't correlate the market. In Elliott Wave forecast, I mean, we have created over the 20 years a system of or trading in which 25% of the forecast is based in Elliott Wave. And we use Elliott Wave more than anything as a language. But there is another 25% that is based in market correlation. There is another percent that is based in cycles. What we explained earlier, the degrees and also the beginning and the end of a cycles. And it's amazing how when we explain it in our daily live session, because we start doing live session broadcasting live around 6 a.m. in the morning, New York time, and we finish around 1. So there is 5 ways daily in which we explain the market, sharing the screen like we're doing now to members every single day. So most of the station that we do, we don't get too much into Elliott Wave details, but most on everything is, listen, this instrument is important because the price action is contrarian to the others, and we use a lot of correlation. So there are 2 types of correlation. First degree correlation. For example, a first degree correlation is when you see that ExxonMobil and oil, they are trending or moving exactly in the same direction. When the direction agree and also the swing direction agree. Now, for us, a second degree correlation is exactly what happened with ExxonMobil for the last year and a half. When Exxon keep trading higher, but oil for the last year or so has been trading lower, or for the last year has been trading lower. You guys won't see it, but every decline in Exxon is an acceleration in oil. And every acceleration higher in Exxon is a bounce in oil. That's how we define the correlations. So without the correlation, you guys won't be successful in trading. And anyone that doesn't use correlation, it won't last in the market. So any questions so far about correlation? Everyone understand what is the first degree and the second degree correlation, right? Everyone understand that, right? Very clear, right? So these are general topics before we jump into you see the first dimension, second dimension, or first degree, second degree, like we call it, right? So this is important to know, guys. Now, yeah, they use correlation, believe it or not. Bang, on basic. Yeah, they use correlation. They relate each other. Everything, the market is a perfect machine. Every instrument, these high frequency trading machines, they have like a program, right? They have triggers, in which they know when the cycle ends, and they communicate against each other in order to correlate. But they create the correlation, because the question that I got is this machine do use correlation? No, they create the correlation. They don't use it. They make the correlation. Very good. Now, right here, I think that you guys have what you guys need to understand what I'm going to explain now. So, like I say, what is the main thing of the seminar? Is to lead you guys to an idea. Of course, we are going to show you guys 1 hour chart of gold or 4 hour charts of gold. It's an overall view of the market in commodities. So you're going to know with the idea, you're going to say, oh, I will be bearish commodities in 2023, or I will be bullish commodities in 2023. That's the main idea here, right? So having explained all this, let's start seeing stone charts, right? And the first one that I want to show you guys is ExxonMobil. This is ExxonMobil within the grand super cycle. In other words, it's the whole history of ExxonMobil. In our system, ExxonMobil is showing a bullish sequence. What is a bullish sequence? It's very simple. If you go and you look at ExxonMobil, ExxonMobil finished sideways in 2014, declined in 3 ways. So ExxonMobil is bullish, very bullish. Right? So ExxonMobil, I hope you guys see, this peak here is 2008, this peak here is 2014. This is, and this bottom is 2020. Right. So this is the COVID bottom. This is the peak across the indices, and it did this correction in what we call a second degree. Right? So a bullet sequence is when you have this, when you have 1, 2, 3, 4, 5, you got a 6, and you got a 7. A bullet, an impulse in Elliott Wave, it runs in the sequence of 5, 9, 13, 17, 21, 25, 29. That's how an impulse runs, right? That's how an impulse runs, 5, 9, 13. Everyone there that practices Elliott Wave, they should see clear 5 waves in ExxonMobil when the first leg was descended, right? Everyone understand that, right? 1, 2, 3, 4, 5 in the primary degree. It finished that cycle and put back right there and put back in 3 ways, right? So now, after the first 5, ExxonMobil put back and make it a new high. So ExxonMobil, he needs to do and accelerate higher in something similar like this. So for now, you have 1, 2, 3, 4, 5, 6, and 7 is bullish. And this rally in ExxonMobil is showing a less momentum than the previous rally. That momentum here, it needs to erase this strength in the RSI. Consequently, ExxonMobil is there very bullish. Everyone understand that, right? What is bullish? It's like if I show you guys a spy, a name, like I explained to you guys previously, and I show the net and Elliott Wave, you guys might see now that ExxonMobil did buy and ExxonMobil is entering here. So ExxonMobil should be most likely at some place around here. It's the same identical picture, right? 1, 2, and here. Everyone see it? So ExxonMobil is bullish there. It will be in Q2 in the next few days, not today, in the next few days. So ExxonMobil, it, you never label a wave B. No, that's another rule that we apply in Elliott Wave. You never label a flat hinging against the obvious. What is the obvious in Elliott in ExxonMobil? Being a flat or being bullish, in your opinion? It's bullish, right? Why you gonna label a flat? That's what happened to most of the traders in 2010 with the S&P and 2011. That they keep labeling a flat and the market never looks back. So as a rule in Elliott Wave forecast, we never label flat. If it becomes a flat, so be. But this doesn't look like a correction either. This looks like an import, so it cannot be a flat. I mean, nothing is 100% absolute, but there is no reason to label it flat. So the first conclusion that we have is that ExxonMobil right here is showing a bullish sequence within the grand super cycle. So the idea that ExxonMobil is bullish within the grand super cycle there, I cannot be bearish the commodity. Just seeing this. Because this implies that everything related to oil is bullish. Any stock related to oil is bullish. And if oil is bullish, that implies that if ExxonMobil is bullish, that implies that the S&P is also bullish. Because at the end, they trade the same cycle, right? They trade the same side of the market. They are both bullish. Yes, oscillation can change, and what we call, explained to you guys already, a second degree correlation, like they did for a period right here, from this period right here. But they always catch up. So the S&P is also bullish. And if the S&P is bullish and ExxonMobil is bullish, it's hard to see oil bearish. Right? So it's a domino effect across the market. So everyone understands why ExxonMobil is a bullish sequence, right? Everyone understands why ExxonMobil is a bullish sequence. Everyone? Everyone understand that, right? Why is a bullish sequence? Now, the next one that I want to mention is related to gold. It's called Royal Gold. How many swings do you guys see within the grand super cycle here? 1, 2, 3, 4, and 5. What did I say about when you see 5 swings? It's always bullish. Either it can be like this, or it can be nesting. In the case of nesting, it goes like this, and then there is another lesser degree, and next with the with gold, royal gold in this case, nesting in 3 degrees before the acceleration. So the idea that royal gold is showing 5 swing higher from the within the grand super cycle is telling me that I have to be aggressive and buy any 3 ways pullback, right? Like the bouncing from our blue box area, which is over here. That's what is bound, right? Everyone understand that, right? Then we put the 5 swing in royal gold. The 5 swings there make gold bullish within the grand super cycle, right? Everyone understands the second topic. Then we're gonna look at the FTSE right here. And this is FTSE. Everyone knows what FTSE is, right? It's the index from UK. It's the index from UK, right? So FTSE is showing also a bullish sequence. You got the grand super cycle, the correction in 2009, another new high, technically 3 swing higher, but very important, this area overlap. For those that practice Elliott Wave, for those that practice a Elliott Wave, right there, everyone needs to understand that the wave 3, you can have overlap in wave 5. You can have overlap in a wave 1. You cannot have overlap in a wave 3, right? So eventually, FTSE is showing 1, 2, 1, 2, 8, breaking higher. And this is the net, because the nature of this third swing being overlapped, guess what? Do not say that it's 5 waves, it's 5 swings in a net. You don't need to be a genius and figure it out that if you put ExxonMobil in top of the FTSE, what do you think is going to happen? They trade the same type. They are almost identical, right? You see, this is how you use and you are able to forecast the market using these correlations across the instruments that participate in the market. This is not just about gold. This is not just about oil. This is about the whole market, right? This is about the whole market and what the market is telling us, right? Now, so if the FTSE is bullish, ExxonMobil is bullish. And if ExxonMobil is bullish, believe it or not, if I put there royal gold, Royal Gold, you guys see it. And honestly, I wish you guys told me if you guys ever seen an analysis of the market like this. Look, they are all trending in the same direction. Don't you agree? They are all trending in the same direction. Right? Everyone, everything is trending in the same direction. The correlation helps you to identify the net together with all the tools that we use and also the price action, right? Now, now, eh, now, we have here, everyone understands the concept right here between among the correlations in the instrument. Exxon and Royal Gold are unrelated in 2020. I don't think so. This one declined here, this one declined here. They were identical. Right? They were identical. Benjamin, they were identical. They all found the law at the same time. Right? They all rally and remember, they all rally and remember, every instrument has the light on its own, but they all trade together. Right? Yeah, the correlation is perfect. And the high frequency trading machines respect the correlation perfect. It's just our brain to identify the type of correlation, if they're trading in first degree or second degree, and being able to understand it. For example, saying here to here, ExxonMobil, they peak together. You see how they decline together here? Then both were supported, and in the next decline in ExxonMobil, oil declined, and that oil or Royal Gold reach the equilibrium here, it makes ExxonMobil more bullish. So technically, this period was direct correlation. First degree, this was second degree. But in this period, they agreed on the swing, not in the overall direction. That's what we hear to identify this and present it to members. So everyone understands what does ExxonMobil bullish sequence within the grand super cycle is saying about the commodities, that they're bullish, right? Everyone knows what Royal Gold 5 swing saying about commodities, that that I don't play fundamentals in the market. Let's be clear, the disclaimer. I don't even know what CPI is. I don't even know nothing about fundamentals. I'm just a person that creates a technical trading system that it works, and it has worked for thousands and thousands of members over 20 years. So I don't play fundamentals. Fundamentals adjust to what the market is going to do. That's the bottom line. So, and everyone understands the FTSE sequence, how also affect not only the indices, but also affect the commodities. Because, for example, GDS is the gold ETF, one of the gold ETF. And if I put here GDS together with FTSE, we can see how they trade when this rally, FTSE rally. When this decline, GDS decline. When this rally, FTSE rally. When this declines, FTSE decline. They trade the same side of the market. Of course, they don't trade in the same magnitude, and the magnitude is the magnitude is, it cannot be equal, because otherwise, for example, if silver and gold, they would trade at the same magnitude, the gold to silver ratio, we we're gonna cover later, guess what? It would be in a straight line. So they all related, right? And what I'm trying to say is that if FTSE is bullish because it cannot be bearish, you need to understand that the ETF of gold, silver, oil cannot be bearish. They have to be bullish. And then you find the Elliott Wave view that fits the bullishness of FTSE. If ExxonMobil is bullish with a bullish sequence, oil cannot be bearish. You find the Elliott Wave structure that fits oil bullish. That's what I'm saying. So these three instruments, Exxon, Royal Gold, and FTSE, are telling me what is the outcome for the commodities, which is bullish. Also, we have something that is called the gold to silver ratio. What is the gold to silver ratio? The gold to silver ratio is a chart that measures how gold relates to silver, right? And this is the grand super cycle of the gold to silver ratio. Of course, if the index from Brazil, of course, it's going to correlate with commodities, of course. The same that the dollar has relate to oil. Now, this is the gold to silver ratio. And the gold to silver ratio from the zero line, it reach the equalex area over here, right? It reach the equalex area over there. But from that area, if we downgrade gold to silver ratio, it did an import, a clear impulse coming from here. 1, 2, 1, 2, 3, 4, 5, 4, and 5. And now it did 3 waves with that. So the idea that gold to silver ratio trade lower here is telling me that sooner or later, this ratio is going to trade lower. And when the gold to silver ratio trade lower, commodities rally, right? Commodities rally. That's the nature. So all I see across the market is that the commodities are set to rally. Then we have also the chart of the dollar, because remember, commodities are trading against the US dollar. And when we look at the dollar and we look at commodities, the dollar within the grand super cycle, the dollar within the grand super cycle here is showing 5 waves from 2008. 1, 2, 3, 4, and 5. So the dollar is set to sell either after new highs or from the peak right here in 2022. So the dollar is about to get weak. It's clearly 1, 2, 3, 4, and 5. It's 5 waves with momentum divergency on wave 5. So the dollar is also said to be weak. A weakness in the dollar means oil higher, gold higher, means indices higher, means silver higher. There is another aspect that I want to mention, which is that sometimes traders, they miss the common sense of the market or critical thinking of the market. Each commodity has, in the price that you see, there is a production cost, right? And if we take a look at silver, for example, silver trade at $11.76 an ounce back in 2020. We were screaming to members to buy that dip and that blue box that was presented there. The production cost in silver, I think it's about $7 to $8 an ounce, right? A silver reacts and it imports matter here. And from there, it did a correction in 3 ways. So the market, is like when it's correcting, it corrects in 3, 7, and 11, right? It's correct in 3, 7, and 11. And if we take a look at silver right here, if we take a look at silver right here and we put the grand super cycle right here in silver, let's remove the labels for a second. Silver did a 3-way, it did it right here, ended the grand super cycle here in 5 ways, and it put back in 3 ways to the buying area. That explains it right there, to the buying area around 1385. Now, when the market is correcting, the market corrects 1, 2, 3, it does 4, and it does 7. Either it rallies after 3 or it rallies after 7. In a reasonable mind, it is impossible for silver to make, assuming that this is 3, is 5, but it's impossible to silver to trade lower. Why? Because in that stage, what's gonna happen? That silver, it would trade below 0, right? Because the market, in the case of silver, do not have room to trade. Let's say that it ended here. Let's say that it did a flat, which is not the case. It doesn't have room to reach the 100% because it's -8. So the common sense is that silver is running out of space to the downside. And seeing silver reacted the way it did, right? The way it did. Seeing silver reacted the way it did from our Ecolex area here and our Ecolex buying area here. I cannot see silver because do not have a space to the downside. I do recall back in 2012 or 14 that every waiver got blindly, right? Because they were labeling this 1, 2, 3, 4, and 5. And everyone thought that gold from around this area is gonna trade to 700, 600. And I remember us telling members, that cannot happen. That cannot happen because silver do not have a space to trade lower. And I think that this is the same case here now, that silver do not have a space to trade lower. So when I put everything in conclusion and I say that Epson has a bullet sequence, that a FTSE is bullish in a net, that Royal Gold is showing 5 swing, that silver do not have a space to the downside, I cannot be bearish the commodities. And I have to believe that they're gonna rally into new all-time highs. Our members, I mean, I can show you, this is another one. This is the commodity index, an ETF, and it's reacting from 2008 related to 2011 from the equalex area. And I expecting to start to react higher when oil, because this is most based in oil, when oil reacted higher. So our view is, and I'm going to show you guys some ETF. For example, this is another gold ETF. Very nice, grand super cycle, 1, 2, 3, 4, 5, and 3 waves pullback. And look at the reaction from our blue box buying area. Very important. I have to be bullish. This is another gold related ETF. It looks like it's nesting higher, but doesn't have room to the downside. Does everyone understand when I mention that they're running out of space, that they don't have room to the downside? Everyone understands what I mean. Everyone understands what I mean. Because this cannot be another leg lower, because otherwise it goes out of market, right? Otherwise it would go out of the market. It do not have room right there. Everyone understand the concept. So what happening is that the traders for the last 2 years have seen that gold, silver, and oil has been declining, that copper has been declining. So what happened? They believe that they're going to continue, and that got trapped. We were telling members to buy gold and silver and all commodities. So this one do not have rooms. This is another ETF, which is nesting. This is a gold ETF, Grand Super Cycle 1, 2, and now with the bullish sequence. It has to be bullish, right? And also reacting to our blue box area. Reacting to our blue box area. Right here. Then I keep going because we track all those ETFs. Another a grand super cycle bullishness reacting to our blue buying area right here. Right? Very nice, right? Benjamin Williams, Eduardo, very nice, right? How we were able to catch the move, anticipating and not only trading gold, because I can show you here, for example, the chart of gold presented to members when we started buying. I think that in our live trading room, we buy in silver because of the ratio. But look at the charts of gold, right? This is when gold was back on September 17th. And this is the real chart of gold, right? Very nice, right? We knew that the correction was coming to the end. And we knew that the right trade was buying the dip over here in that blue box area. This is the real chart. So I show you guys several gold ETFs that most of you guys don't track it. Most of you guys don't even track it, right? But as a professional trader, we track it in the daily basis, because our goal is to keep you guys in the right side of the market, right? Now, silver ETF. Look, this is silver ETF, Grand Super Cycle. It has to be nesting. Keep in mind, guys, this is zero. And this cycle ended. How come this is gonna trade down here. It doesn't work that way. Another silver is here. This is 11. This is 0. So, and it did 3 waves put back right here to our buying area, perfectly to our buying area. And then I put it this way. I think overall, Maya, that these commodities, they're gonna repeat the grand super cycle. In other words, I believe nesting is missing by most of the traders, but not for us, because we track it, Hector. We know when a nest is taking place, right? So eventually, and nesting is a trap because makes traders to look to the other side, right? So this is silver as an example. Everyone knows that silver ended the grand super cycle correction in 2011, right? And I believe that from 0 to the peak at 49 related to the low, silver is gonna rally into the 61 area, right? Because I believe that all these commodities are going to repeat the same cycle that they ended around 2011. Some of them, like oil, they are ahead. Some of them, like ExxonMobil, they are ahead. Everything is the same, Walmart. The mining stock, they're gonna rally also, right? ExxonMobil is a stock from oil, related to oil. So any mining stock also will rally. And I believe that we are at the beginning of a huge acceleration in the commodities that they would take it to the 100% extension in from the grand super cycle. The same happened back in 2009 on the real estate market, right? In the real estate market, the same happened there. Let me see. I should have some ways the charts of real estate. I should have it somewhere right here. I think that the commodities are right now when we were sometimes in 2010, 2011 in the real estate market. I'm going to explain what I mean. Let the chart open. And I hope you guys learn out of this seminar how in Elliott Wave forecast, we are not just trading gold, we are trading everything. And that makes the difference between us and the other servers that they concentrate in the price action, they concentrate just in the price action of an individual instrument. And that's why they get it wrong most of the time. Right here, the real estate in the US ended the grand super cycle in 2010. In 2009, it's starting to go higher. And guess what? Already reached the 100% extension between this cycle and the new leg. I think that commodities are set to follow that path. And they're gonna rally for the years to come into the 100% within the grand super cycle. Same will happen with ExxonMobil, which it has a target that put ExxonMobil someplace around, put ExxonMobil someplace around 135, even higher. And that's gonna bring and that's gonna bring right there a oil within, right? It's like oil. It's like oil. It's like oil. Oil right now is trading within a daily blue box buying area. It's lagging. Overall, it's lagging right here. It's lagging the ExxonMobil. And the lagging of ExxonMobil and oil, it can make ExxonMobil instead. Because by nature, you're going to say ExxonMobil is going to correct and higher, right? By nature. By nature, it's going to make you say that ExxonMobil is going to correct and higher. But when you look oil being at the E-collect blue box area from here, most likely it's going to make ExxonMobil to net. And that's how we see the market. Don't you guys agree with me, William, Benjamin, Echo, that the way that we look at the market is completely different to most because it's completely it's completely different to most, right? Because most people don't look at this way. Most people they just trade one instrument. We look at the whole market, right? We look at the market as a whole in a way that everything relates, and in a way that we identify the move ahead of the move happening instead of saying now, okay, ExxonMobil is going to put back in three because I see 5 ways from here. Yes, no question asked that if you downgrade it, you can make the case that ExxonMobil from the lows of 2020, right there, it can be labeled in 5 ways if you want it, right? 1, 2, 1, 2, 3, 4, 3, 4, and 5. And you can say, okay, ExxonMobil is gonna do this, and yeah, that's ExxonMobil, but the rest of the commodities or commodity related stocks do not support the view. So that's how you are able to catch a net. And then instead of labeling like that, you label 1, 2, oh, 1, 2, right here. Another 1, 2, 1, 2, and you catch it. And you don't get caught in the wrong side or selling ExxonMobil because you have 5 ways. So our view is very simple. Our view is very simple, right? Which is that when we look into conclusion here and we see that most of the ETFs from silver do not have room to the downside right here, that some of the ETFs and gold are nesting higher when we see the commodity index and E-collect and reacting, when we see oil and E-collect, when we see ExxonMobil with the bullet sequence within the grand super cycle, when we see 5-way and Royal Gold, and we see FTSE bullish that implies indices higher, right? Indices higher, but not only the indices, or not only the indices, also implies a commodity stocks, a mining stocks, everything higher. You have to believe. You have to believe that you have to believe that the commodity is gonna rally in 2023. I don't know how long the cycle will last. Price is always hard to forecast, right? But I believe, like I say, that silver, our belief is being that silver goes to 61. Our belief is that gold goes to around 3,000, 4,000. And it can take years. If you do the simple exercise here, it took silver 856 months to reach this peak. 856 months, it is a lot of years, right? It can take years, but it can take years. But one thing that they are known, they are bearish. They are no bearish. It can take years in a bullish. They can be bullish for years to come, right? Because the commodity is always going to be bullish, Benjamin. That's another thing that most trading miss, which is a critical thinking. It's like people calling a crash in the indices. Yeah, the index is going to put back. Yeah, the index is going to correct for time to time. Right? The index is going to correct from time to time. But the commodities in the history of humankind, what do you think has been, Benjamin? Bullish or bearish? Commodities in the history of humankind. What do you think? Anyone? They've always been bullish. So it's my belief, and it's a belief in Elliott Wave Analysis, the same, that you never look for crashes in commodities, you never look for crashes in the indices. And then when they give you the opportunity to put back both groups, commodities and indices, you're always looking to buy instead of selling, because the trend always gonna bail you out when it comes to commodities and indices. And I refer to indices, not individual stocks, because the stocks, they can go out of business, but the index never go out of business. And the commodity never gonna disappear. Oil always gonna be there, and always, it's like real estate. You can, I don't know if you guys ever think about this. You can buy a house, and the value of the house never gonna be zero. Why? Because the land always gonna have value, and because the structure always gonna have value. So there were people in 2007 that they bought real estate, and they saw being on the water for a period of time, for 2 years. But now, or more than 2 years, but now the value past the 2007 peak is the same with commodities. So we always have seen commodities as a buying opportunity instead of selling opportunity. And we believe that an acceleration can take place sometimes at the end of 2023 or sometimes in 2024, depending of the dollar, if the dollar needs to make new highs or not. To our members, they have been instructed for the last 3 months in a series of steps that the market will take. And I believe that those steps that the market can take, it's going to be an opportunity sometimes, like I say, at the end of 2023, when the acceleration higher in commodities will come. And many things can happen. I cannot disclose those things in this seminar because this is a public seminar, not a member seminar. But they know what some instrument needs to do before that acceleration happens. But the market in the commodities is very clear, which is that is very bullish, right? Yeah, dollar is a basket, exactly. Dollar is a basket. Uranium should be bullish also, and the miners should be bullish also, Gregor, right? So, in conclusion, guys, it's very simple, our view, right? In conclusion, our view is very simple. That looking across the market, we're seeing that the US dollar is ending sideways from 2008. We're seeing indices like FTSE into new all-time highs, and it cannot be sideways. We can see also ExxonMobil with a bullet sequence. Some of the dollar ETF with a bullet sequence. Silver running out of space to the downside. And that makes us believe that the market is going to enter an index dynamic and the negative US dollar dynamic that will rule the market for new few years ahead. In that environment, commodities going to be king. In that environment, commodities going to rally into new all-time highs. That's our view about the market. So I hope that you find I hope that you guys find the seminar interesting. I hope that you guys, any question that you have about what we presented, and I hope you guys understand, I cannot be showing you guys the 4-hour charts of silver, gold, oil, because we are a membership type, right? But we give you guys enough, I believe, for you guys to understand that selling commodities long term is a bad trade. And you guys understand that and remember, the market doesn't move in a straight line. And I'm not saying that gold or silver is gonna go, gold is gonna go for here straight to 3,000 or 4,000, or silver is gonna go from here straight to 60. I'm not saying that. They're gonna be pullbacks in between. But the right side is very clear. It's a bullish commodity group. That's the idea of the seminar. Now, any question you guys have, any question you guys might have. Exactly. Open your mind and be critical thinking. Exactly. Exactly, Frederick. Frederick said you spray natural gas. I don't do natural gas myself. It's done by another analyst. But it can, I think that natural gas is acting, Frederick, like the technology sector, right? Like the technology sector is within the stocks, the sectors, right? When the technology sector is acting contrarian to many indices, if you understand what I mean. I challenge you, you are a member again. Look at the natural gas, right? Look at the natural gas and look at, for example, you compare natural gas to oil. I think that natural gas is gonna find a low in the first pullback of oil. The same way, the S&P and some of the indices like the FTSE, they're gonna find in the first pullback of the FTSE, some of the technology sectors are gonna find a low. That's how the correlation play out, brother. I hope that answers your question, right? Aaron asked, no large pullback Yeah, there would be a pullback in silver and gold, of course, because the cycle that started here, this cycle in silver, as an example, in gold, this cycle won't be in a straight line. At one moment, you're gonna get a pullback like this, I guess. At one moment, you're gonna get a pullback against these lows, right? Benjamin wants me to check DVA. You need to give me the symbol, the EC no, symbol, and I will look at it for you, right? I think it's this one, right? Yeah, this one is bullish. It's bullish. And this one is in the can that in the first pullback of the commodity, this one can see this area and rally. It's the same. I guess you look at this symbol. Look, you see it there, right? But this is Benjamin how we operate in Elliott Wave Analysis. I saw the structure and I already knew that it's related to this one. Look. You see? I knew I'm seeing the structure. You see? It's not magic, it's knowledge of the market. I knew automatically. And I hope you guys, you see, it reacted perfectly from the 1408. We don't call it this one, but it reacted perfectly for the 1408 100% extension. The same way that this reacted from the own extension. Gold and silver, they peak over here. Most of the commodities peak over here. Aussie peak over here. So I hope that answers your question, Benjamin. Right? I don't know if it's going to truncate. I don't know if it's going to truncate. I don't know. It doesn't say. I don't know. That's hard to say. That's hard to say. I don't have the answer. For the long-term investor, considering your view, I'm a long-term investor myself, Frederick. I don't have time to trade too much because I'm very busy with the operation of Elliott Wave Forecast. But the reality of the matter is that in my basket I do trade, yeah. I own ETF or silver long term. I own also physical gold and silver long term. I buy stocks long term, right? So personally, it's very simple, guys. It's critical thinking. Two things you can do when it comes to commodities and when it comes to indices. Either you sell them or you buy them. I hope that after the explanation that I explained to you guys, what I explained to you guys today is very clear that selling commodities is not a good idea. It's very clear that selling indices is not a good idea. I hope it gets clear, right? Everyone, it gets clear. So you have to find a balance in your portfolio and get some long term. If you can get some physical also. Or is the evidence? Are you a member, Hector? I don't know which commodity, agricultural commodity is going to be more bullish. I don't know. That's hard to say. I don't know. I still believe it's my view that I don't know. I don't do group 3, Bergen. My view is that still, I don't think that they have scored a low in the technology sector. I don't know when you say that. I don't know. Maybe you know more than me, right? This is not about S&P, guys. This is not about nothing like that. This is not about the technology sector. This is about commodities. If you want to know the view, guys, listen, it's very simple. I invite you guys, go here, click on Elliott Wave Forecast. There is a 14-day trial for $9.99. You're going to see the view in the commodities. In the technology sector, you're going to see the view in the S&P. Out of respect, I cannot share that view here. Our view is inside members area. I mean, the question, I have a bunch of questions. Should we buy commodity as an investment, as a trader? My answer is, you should buy it both. William. I do have some as an investor, like physical gold and silver. I still have some ETF as a trader. How would I label this chart? Very simple. An ABC from the lows, from this peak. 1, 2, 3, 4, 5, 3 back, 1, 2, 3, 4, 5, something like that. That's an ABC. That it went perfectly to the buying area. And that rally from this area, not because fundamental, nothing like that. That rally from that area because it reached the area when computers gonna buy. And because it was running out of space to the downside. Let me see questions here. Questions. S&P going, our views in the members area. Silver is a better long trade for profit. Yeah, I think that silver will outrun gold in the next 2 years. Nunya, right? Because of the gold to silver ratio, right? Because of the gold to silver ratio, it needs to make another leg lower, right here. So in this period, right here, in which gold to silver ratio is gonna stay here, right? In this period, right here, silver is going to outrun gold. How do you see the dollar? Again, the dollar view is inside our members area. I think it's ending a cycle from 2008. What do I say about oil correlation? That you got stocks like ExxonMobil, which already are showing bullet sequence, and consequently, oil is about to rise. Which advantage will I have to buy gold or silver? You mean physical silver? Marco? The ETF allow you to enter more in and out of the market. That's the advantage. When you buy physical silver and gold, you have to go through a process before you sell it. That's the thing. I don't know, Benjamin, if you need to buy ExxonMobil now or wait. Again, our view of ExxonMobil is inside the members area. We cannot disclose those things. The idea of the seminar is not give you guys details about the short cycle. It's about to tell you guys how we see commodities in the near future for the next few years. and we made the case that they're gonna be bullish. The GDS and silver ETF, I like it. I like it. I don't know if they are a better trade, right? I don't know if they are a better trade. I think that this is another ETF. It's the same. It's the same. But this is related to silver. I think that in the short term, next 2 years, it's gonna be better than GDS, if that's what you ask. Because the gold to silver ratio. We always do an Elliott Wave forecast, a filter, and we use correlation. You see, the structure, they are identical, right? Nunia, the structure is identical, right? Pretty much identical. But if you use your brain, and I'm telling you that the gold to silver ratio, right? That the gold to silver ratio, it should trade lower. I guess that for a period of time, this one will outrun this one for a period of time. They both trade higher, but this one will pay you more for your money than this one. That's for the ranking. We call that in our system the ranking. You got it? Any other question, guys, before we finish? Of course that I will buy. I've been long silver ETF that they reach the equivalent. I think I bought this one. No, I bought this one. I bought one of them. In the middle term, silver will be better. Onto the silver ETF reach the equivalent area, right? Onto the silver ETF reach the equivalent area, I think, which is lower, of course, right here, at 33. Onto then, I guess that silver is gonna outrun gold. So it's better silver ETF than gold ETF. Everything is the same, Aaron. Everything related to commodities, it should rally within the next 2 years. It should be rally with an acceleration at the end of the year, right? So, guys, I hope you guys understand what our point was to be made about why we believe that commodity is going to be supported. I hope that you guys appreciate the deep in our analysis, how we are not just trading one commodity, we're trading the whole spectrum of the market, how we relate commodities to an index from UK, how we relate commodities to everything, to the dollar, to everything, and how we came out with that forecast. We are not selling here perfection. Nobody's perfect. We are not perfect, but we are very good in locating the right side of the market. And you guys can see that in the seminar. Why we draw a conclusion. We don't draw a conclusion based on fundamentals. We draw a conclusion based in the overall analysis of the whole market, from Forex in dollar, with the dollar, to the indexes and FTSE. We understand how the FTSE affects the ETF. We understand how the dollar affects silver, and we draw the conclusion. If you guys like the analysis, and you guys have never seen something so deep into the analysis, I invite you guys, honestly, to take the trial. The trial is here in the homepage of Elliott Wave Forecast. It's here in the homepage of Elliott Wave Forecast. You can take it and you will learn a lot with us, right? So that's the idea. You should not have that, Marco. So that's the idea that we see around the market with the commodities. And invite you guys all to take the trial here. You just click here, you fill out the form, and you take the trial. It's just $9.99 for 14 days. Believe me, after 14 days, you're gonna have an opinion if you are a commodity trader, and you're gonna see if you like our work or not, right? This chart right here is not hard to count. This is 1, 2, 3, 4, and 5. Like this. This one is 5 weeks down and 3 weeks, an ABC up to here. Now it needs to decide to the downside, right? Any more questions, guys? No more questions, my bad. I wish you guys all a nice weekend, and I hope that some of you guys, the 100 of people there that be here in the seminar, that take the trial. You're gonna learn a lot using Elliott Wave Forecast as your service provider. Have a good weekend, everyone. Thank you guys all for your time here.